This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. I hope everyone is doing well and enjoying Christmas holiday. And welcome to this another episode. This is episode 40. And over the last 5 episodes, we talked about Philip Fisher, and I'm going to continue to talk about him in this episode. In the last episode, we talked about 5 don'ts for investors, and in this episode, I'm going to talk about 5 more don'ts for investors, no pun intended, but that was another chapter in his book. I feel that I learned quite a lot from Philip Fisher, who is a little bit different from Warren Buffett. And even though Warren Buffett mentioned in the past that he is comprised of 80%, actually 85% Ben Graham and 15% Philip Fisher. So Warren Buffett definitely got influenced by Philip Fisher, and that's how I got interested in the first place. But when I reread his book this time, I feel that I gained a lot more insight. And it kind of influenced my investment philosophy that I already have established so far. Because so far I focused a lot on value stocks. And I put some emphasis on the future growth aspects of the companies that I have. But I didn't really particularly focus on catalysts and things like that, even though I knew the existence of this type of approach. I was a little bit convinced by his investment philosophy and investment approach. And I think that it's a really important turning point for me to read this book again for this podcast. But as I was reviewing the list of stocks that I already have, I realized that I already took into account certain aspects that were discussed in his book. So what I'm going to do for this episode is that just like the last 5 episodes, I'm going to go over some of the details written in his book, Common Stocks and Uncommon Profits. The first 2 episodes, we talked about how Philip Fisher identifies outstanding growth stocks and 15 key traits that you need to look for when it comes to finding outstanding stocks. And subsequent episode, we talked about when to buy and sell stocks. And in the last episode, we talked about 5 common mistakes. And we're going to talk about 5 more common mistakes that investors are making when they invest their money in the stock market. So before we get started, let me just give you a quick disclaimer, as always, that this podcast is for entertainment purposes only. And it is your responsibility to consult with your investment professional for any investment decisions. So without further delay, let's just get into the topics. Okay, so the first thing that Philip Fisher mentioned that investors shouldn't do is don't overstress diversification. We already discussed this topic when we talked about Warren Buffett, and Warren Buffett is also not a big fan of diversification. So he said that diversification is something that is necessary for people who do not understand companies. So if you do not have good understanding of the companies that you're trying to put it into your portfolio, you'll be better off if you just purchase broad market index fund. But that was just Warren Buffett's advice, and let's see how Philip Fisher thinks about diversification. Philip Fisher said that the popular advice is as follows. Don't put all your eggs in one basket, and this is very common advice when it comes to investing. However, Philip Fisher disagrees to a certain degree. He said that the disadvantage of having eggs in so many different baskets would be a lot of eggs don't end up in really attractive baskets. He said that you might have to give up on certain capital appreciation potential if you spread out your eggs, so to speak, across different baskets. And it is impossible to keep watching all the baskets after the eggs get put into them. So let's say you have more than 25 stocks. then Philip Fisher is arguing that only a small percentage of such holdings is in attractive stocks, where you have high degree of knowledge. So if you're a trained investor, you'd know that how difficult it is to understand more than 10 companies. Seriously. It requires a lot of research and effort in order to understand to certain confidence level about the companies that you're interested in. It's almost near impossible to understand more than, let's say, 100 companies. So Philip Fisher is arguing that buying a company without sufficient knowledge may be even more dangerous than having inadequate diversification. So there's a balance between too much diversification and too little diversification. Philip Fisher is asking question, how much diversification is really necessary and how much is dangerous? He said that the answer depends on two things. First, it depends on the kind of companies that you invest your money in. For example, if you invest your money in companies like Berkshire Hathaway, very large cap with many subsidiaries that operate independently across different industries, then there's already internal diversification built into this stock. Which makes sense, right? The Berkshire Hathaway has a lot of companies under one roof across different industries, so you already have diversification built into the stock. Also, the answer depends on industry diversification. If you own, let's say, 10 stocks and all of them are in banking industry, then you're not going to have enough diversification. You cannot say that you diversify your portfolio. So Philip Fisher thinks that a certain level of diversification is necessary, but not too much. And he said that there's no precise rule, but he can provide a rough guide and framework as to what might be considered as minimum diversification needs for retail investors. The framework is based on the market capitalization of the companies. So let me just give you 3 different cases where retail investors can use this rough measure to understand whether or not they did the diversification in a right manner. So let's just assume the first case. In the first case, retail investors could have all the investments in large cap stocks, let's say market cap greater than $10 billion. Then you might have a minimum goal of 5 such stocks in your portfolio. In other words, you'd not invest over 20% of your initial original commitment in any of these stocks. So 20% is minimum threshold. So you don't want to go above that. But that doesn't mean that should one stock grow more rapidly than the rest, so that 10 years later you found 40% of your portfolio in one stock, you should in any sense disturb such a holding. So let's say you have $100,000 and you invest $20,000 in large cap stocks, and one stock grows really fast over the course of your investment time horizon. Let's say after 10 years, one stock becomes 40%. You don't want to touch that just because of diversification purposes. Philip Fisher thinks that that's stupid. So don't disrupt your growth stock when it becomes a large portion of your portfolio. Of course, these stocks should be in different industries in order to get the benefit of diversification. The second case is some or all of your investments fall into the category of small and mid-cap stocks. So the companies in this category would have a good management team rather than one-man management. So it's not micro-cap companies. It's a company with a management team instead of just run by one man or founder. Companies in this category would typically have the market cap between $300 million to $10 billion. Philip Fisher thinks that at least 2 of such companies should be considered as necessary to balance each single company of large cap discussed in case 1. So in other words, this would make a total of 10 stocks in your portfolio, and you can say differently, 8 to 10% of your total investment in one stock. I think this threshold makes sense. That's how I assessed this approach. And when I reviewed my portfolio and see how many stocks that I have and what proportion I spread out in my total portfolio, I think it made perfect sense. Because I consider myself to be falling into this category because some of my good investment ideas account for 8 to 10% of total portfolio. I think that's a good significant amount to have meaningful impact on the portfolio, but I don't want to risk too much in a sense that I go down with the investment if my original thesis is wrong. So if one stock that I have in my portfolio, which accounts for 10% of my overall portfolio money, and if this stock does fantastically well, then I'm going to get all the benefit. But if this stock goes down in price, but I can still rely on 9 other stocks that I picked personally, and these 9 other stocks can offset the loss that I experienced in this one particular portfolio. So that's directly the benefit of doing the diversification. So let's move on to the case 3, where Philip Fisher is saying, finally, there are small companies with staggering possibilities of gain for the successful, but complete or almost complete loss of investment for the unsuccessful. Here, Philip Fisher is saying that 2 golden rules to follow. For retail investors, never put any funds into them that you cannot afford to lose. So remember, this is the microcap stocks, less than $300 million. So there's big probability in the future that you're going to make tons of money or you can lose it all. So for retail investors, Philip Fisher is suggesting don't put any funds if you cannot afford to lose. And for institutional investors, Philip Fisher is saying that don't put over 5% of available funds into any one such company. These are the companies run by one founder or a couple of founders, and very, very in a dangerous stage because they don't have established processes and procedures to run the company, and a lot of things that are happening in the company is managed by a couple of management people. So they don't have a strong foundation yet. So that's why it's risky to invest in this type of space. And in the last episode, I think we discussed a similar topic, and Philip Fisher just thinks that it has to be left to specialized groups such as venture capitalists and angel investors for this type of situation because they have the know-how and expertise, management expertise that can help the company thrive. But as an individual investor, you may not be able to provide those type of skill sets to the management team, and the company can easily go bankrupt and you lose all of your money. So that was about diversification from Philip Fisher. So let's move on to the next mistake. And things that investors shouldn't do is don't forget your Gilbert and Sullivan. So this is a metaphor, but I can rephrase what Philip Fisher is trying to say. He said that don't be influenced by what doesn't matter. There are certain superficial financial statistics which are given an undeserved degree of attention by many investors. So Philip Fisher gave out a couple of examples here. The first one is the price ranges at which a stock has sold in former years. Is it illogical? Is it financially dangerous to pay attention to past price performance? The answer to these questions are yes and yes. Philip Fisher mentioned that it is dangerous because it puts the emphasis on what does not particularly matter and diverts attention from what does matter. What matters is the current price and intrinsic value, but the price 4 years ago may have little or no relationship to the price at which it sells today. But if you think about it, a lot of investors look at the price graph, and that's the first thing they look at. And what they do is they look at their portfolio and sell the stocks that have performed well because they want to take the profit and reallocate that capital, whatever capital gain that you have, you reallocate the capital to the stocks that have not gone up yet. And is it illogical? Yes, it is illogical because it is truly hard to find outstanding growth stocks from Philip Fisher's perspective. So once you find one, you don't want to disrupt their growth. You don't want to disrupt their outstanding performance in the future just because the price has gone up in the past years. It can go up more and more, and you might be able to double or triple your money even after outstanding performance in the past. I think this makes perfect sense to me. I have no objection to what he says, and this is quite important. Just because the stock price dropped in the past doesn't mean that it's not going to drop more. Just because the price has gone up doesn't mean that it's not going to go up more. Look at what happened to Amazon, all these outstanding companies. The price has gone up more and more over time. The past price range is the one example that Philip Fisher gave when it comes to the things that do not matter in the stock market. And another example he provided is the past per earnings trend. And he thinks that this specific metric, the past performance or per share earnings trend, is useful to understand business cycle, and maybe it's going to be useful for stocks in regulated industry with constant cash flow streams. But it is not really useful for outstanding growth companies because the past earnings will not be representative of future earnings, obviously, for growth stocks. So if you just purely focus on earning per share and PE ratio, right now you have 12 months trailing PE ratio, then it's not going to be reflective of true value of the outstanding companies. That's what Philip Fisher said. What matters is what will happen in the future. And if the company is in high growth market, and the company has a great management team who is trying to introduce new products and services in the market, and it's about to seize huge market share through this type of innovation, then the current earning per share is not representative of true value of the stock. And you might have to think about future cash flow and future earnings per share. So let's move on to the next common mistake that investors are making, which is don't be afraid of buying on a war scare. So this is not applicable anymore because in this day and age, we don't really see a lot of wars between different countries. But back then, when Philip Fisher wrote his book, there were a lot of different types of wars, World War I, World War II, and Korean War. So a lot of stocks were reacting in a negative way whenever there's war. But Philip Fisher is arguing here that modern war always causes governments to spend far more than they can possibly collect from their taxpayers while the war is being waged. So there's a lot of circulation in terms of money, and that's going to cause inflation. And the best thing that you can do in order to fight against inflation is to own stocks. So there's no point of selling stocks because of war scare. And during this kind of scary time, a lot of people just sell stocks, and that's going to cause a lot of companies to be undervalued in the stock market. So it's actually a good time to buy more shares. So what's applicable in today's environment is the fact that you can buy more shares if you have some money in your hands whenever we see some corrections or whenever we see some bear markets. So as long as you have some money, you can invest more because everything is selling at cheaper price. Or if you don't have any money in your bank account, then you can just ignore these market fluctuations and you're going to be fine in the future. So let's move on to the next common mistake. Don't fail to consider time as well as price in buying a true growth stock. So Philip Fisher is trying to give an example to make people understand what he's trying to say here. You can have a company, right? You find a company that are expected to grow its earnings about a year later, or at least several years after that, and it's truly good, outstanding company. And the situation is the financial community, Wall Street, has not recognized these new sources of earnings in the stock price. So they have not really reflected that on the stock price. So under normal circumstances, this stock would be a good buy. There's no doubt about that. However, there's one caveat here. Some of the successes in the past years for this stock has given so much glamour that the stock is selling at a certain price that would be considered overpriced without the glamour. So let me give you specific numbers in the book. So let's say the stock can be fairly valued at $20 without the glamour. And this is using the fair P ratio compared to peers in the same industry. So without the past glamour, the stock should be selling at $20. But because of the excitement in the market, this company is selling at $32. And this is relatively high P ratio in the market compared to its peers. But you know, based on your research, that the company should be valued at $75. And the market has not recognized these new sources of earnings yet. And the company is selling it currently at $32. Now the question is, should you buy the stock at the current price $32? Or should you wait until all the excitement fades away and buy the stock at $20? This is a difficult question to answer because if you buy the stock at $32, there is a probability that the stock could fall to $20. And also, there's a risk if you wait that the stock never falls back to $20 level. Then you're going to miss out on buying opportunity for this outstanding company, and stock would probably go up to $75 in the future. So this is a hypothetical situation that you probably may have already faced in the past. And most value investors would not really buy into this investment opportunity because of what appears to be high multiples at the time of the consideration. But the question is, does it make sense? If you really did your research and found out that the future sources of earning will increase the value of the stock to $75, you don't buy into the stock just because of high P ratio or high multiples at the current situation. I think it doesn't make sense. If I were in this situation, I would definitely buy at $32. And even if the stock goes down to $20, I wouldn't really sell because if I have conviction that this stock should be valued at $75 based on future assessment of company's earnings. Philip Fisher had different suggestions in his book. He said that you can consider both price and timing. What he means by timing is that he's asking, why not plan to buy these shares 5 months from today, which will be just 1 month before the pilot plan goes on stream? So when it comes to buying a stock, he said that in this particular situation, investors could determine at what price investors would want to buy, as well as the timing of stock purchase. I don't necessarily agree with Philip Fisher, and as I mentioned, if I were in this situation, I would just buy at $32 and just forget about it for a long time, and eventually stock will go up to $75 if my original thesis is correct. But Philip Fisher had a different suggestion, so I just want to cover both point of views. Let's just move on to the last common mistake. Philip Fisher's advice here is don't follow the crowd. He said that there are fads and styles in the stock market just as there are in women's clothes. The fads can last as much as several years and produce distortions in the relationship of existing prices to real values of the stock. So if the financial community appraises the same set of facts differently depending on various points in time, and you'll see that in some cases, in certain time periods, Wall Street values growth stocks a lot more than value stocks. In other periods, the opposite things happen. So the Mr. Market is a concept that Ben Graham came up with, provides very meaningful insight here because Mr. Market's mood can change anytime and it can actually go on for several years, several months. You don't know exactly how this specific value is going to behave. The best strategy to counter this turbulent mood that Mr. Market has, or you can call it market volatility, you can be a long-term investor and instead of getting influenced by the market, you can just stick with your investment principles and implement your strategies accordingly. Okay, so we covered 5 common mistakes by average investors here in this podcast episode. And I hope that you learned something out of this episode. Let me just quickly go over what we have discussed. First one is don't overstress diversification. Second one, don't be influenced by what doesn't matter. Third one is don't be afraid of buying on a war scare. Fourth one is don't fail to consider time as well as price in buying a true growth stock. The last one is don't follow the crowd. I hope you enjoyed this episode, and before I end, I just want to remind you that please leave your review, comments, rating for this podcast on whichever platform you listen to this podcast. And I hope that you enjoy Christmas holiday and Happy New Year.